Hi, I'm Peter Harper from BetaShares, and today we're going to talk about how you can potentially use ETFs to achieve tactical asset allocation goals in your portfolio. The simplest way to add value through asset allocation is to be in the right asset class at the right point in the economic and business cycle, which is all well and good if you have a crystal ball. Unfortunately, no one does. Given current levels of overall share market uncertainty and increasing volatility, record low interest rates, property market cooling, and a weaker Australian dollar, it's worth looking at the impact tactical asset allocation can have on an investment portfolio. Just what is tactical asset allocation? Well, have you ever bought an international equity exposure because you felt that perhaps the US market would outperform the Australian market? Or have you ever sold down shares and moved to cash because you thought markets were toppy? Both are forms of tactical asset allocation. Using tactical asset allocation or changing your mix of investments to take advantage of short-term market views can be a simple way to potentially achieve improved returns via broadening your investment into other asset classes that may fit the current investment landscape. Achieving this has never been simpler or as cost-effective than with exchange-traded funds. For those that are not using tactical asset allocation, one way to get started is to focus on the decisions you're already making from an asset allocation standpoint and reflecting on whether you think the current level of risk and diversification in your portfolio is acceptable. Of course, any asset allocation decisions should be constantly monitored and evaluated as market conditions change. Achieving tactical asset allocation. If you had a view on the weakening Australian dollar relative to the US dollar, you may take advantage of a US dollar ETF. These funds hold US dollars in a bank account and avoid the cost and complexity of FX trading platforms, CFDs, and foreign currency bank accounts. Other currency funds are also available. Another important example involves moving a portion of an equity portfolio into fixed income to seek to protect against market downturns. The breadth of fixed income and hybrid funds means investors can still maintain attractive income across this asset class while taking on a more defensive portfolio position. The range of exchange-traded fixed income products include government bonds, corporate bonds, floating rate bonds, and also an actively managed hybrid fund. Country and regional exchange-traded funds can also provide opportunities across international markets. If you wanted to invest on a view that the UK or European region was going to strengthen, this is all available on the ASX via a range of exchange-traded funds. Introducing a tactical asset allocation strategy means an investor can potentially enhance their investments by actively managing their portfolio with the aim of increasing reward and reducing risk, partially smoothing the volatility of the business or market cycle, potentially increasing the total amount of alpha available for capture through diversification across multiple asset classes, or providing the potential to perform in both rising and falling markets. However, tactical asset allocation can also be a double-edged sword. It can add to your trading costs, potentially reduce returns and increase portfolio volatility if your views turn out to be incorrect. It's important that you take the time to plan your approach to tactical asset allocation before implementing this strategy. Whilst by no means the only method of implementation, ETFs offer important benefits that can make them an attractive tool for implementing cost-effective, simple and diversified tactical asset allocation decisions.